Many people step into the market with a goal to save money until retirement. For some people, the goal is to grow their net worth over time by consistently saving and investing money during their working years. Rich people, though, plan to live off dividends and investments to achieve financial freedom early and enjoy life while young. Welcome to 5-Star Finance. When stepping into the market, the million-dollar questions that arise in the mind of investors are: how much should they invest? What type of companies should they go for? And how can they live off their dividends? Not everyone can save up to $10,000 annually to invest in the market, but if you're in your working years and are looking for financial freedoms and various streams of income, then one thing's for certain: invest all of your money. The money you don't need, or to be more specific, the margin which you can live off of easily. As a rule of thumb, invest all of your money that you won't need for the next 10 years. Do not invest the money that you need to pay your rent or savings for the education of your children. Since you should invest money you won't need, if the market drops and you lose half of it, your living standards won't drop with it. Let's just say that you manage to generate a source of income other than your regular work. Your regular work, for instance, allows you to take care of your household. At the same time, you can utilize the money you're making through other streams by saving it and investing it for passive and long-term sustainability. Even if the market drops and you lose, let's say, half your money, it won't affect your living standards, as that comes off the extra source of income. How to balance your portfolio. Everyone's interested in growing their money to the limit, where the money is working for them. But only a few are willing to put in the work necessary to achieve their goals. The most common advice out there is that you should balance your portfolio according to your risk tolerance. This means that if you are a conservative investor and looking to preserve your capital, you should own more bonds than stocks. In the same way, if you are an aggressive investor and looking for huge returns, you should own more stocks than bonds. Well, there isn't a particular portfolio balance that could get along with every investor, but the most sustainable way to balance your portfolio should begin with taking into factors like risk tolerance, long-term goals, and evolving investment objectives over time. Everyone wants to maximize their returns with the minimum amount of risk involvement whatsoever. In order to build a balanced portfolio, then start by understanding and creating a portfolio allocation with stocks and bonds. Make sure that you take your risk tolerance into account. After this, you can broaden your vision. For example, you can go for some high-risk investments for a higher return. The best portfolio balancing strategy should always keep risk tolerance in view. Long-term goals and the evolving investment interests should also be taken into account. The next question which arises is: how do we keep up with the risk tolerance? What is risk tolerance? Understanding risk tolerance is very important for investing in the stock market. Let's just say that you have been planning to invest in a telecommunication company. You are getting a table return ranging within 8 to 10%, but the returns will not always go according to your plans. On some days, there could be variability in the returns you are getting as a result of your investments. The margin you are willing to withstand as a result of degradation is known as the risk tolerance. In your financial planning, keeping the risk tolerance in mind means that you are keeping a margin for error. That means that even the worst of conditions cannot affect the way you plan your next move. It is an important factor in investing. This also means that you should look at your capital before you go hunting in the market. If you get eager and take a risk bigger than your stomach can digest, you might end up making wrong decisions and selling at the wrong time. Risk tolerance can also be associated with the age of the person. For example, people who are younger can step into the market at a rather young age, and they have more room for error. They can take more risks and are even encouraged to take risks early. On the other hand, people who are comparatively older are encouraged to play safer. Higher risk tolerance is often linked with equity funds and ETFs, while lower risk funds are associated with various types of bonds, bond funds, and ETFs. Well, in some cases, age cannot hold back someone with a higher net worth. Having a higher net worth can make room for more risks irrespective of your age. How much of a loss are you as an investor willing to endure? The question which remains is that, how do we know when or when not to keep a greater margin for risk tolerance? Sometimes not everything in the market is bright and sunny. The market itself has some dark days. Let's just say that the political events unfolding are not good for the market. or the interest rate has changed, or there is some other swing. Then your portfolio is likely to go on the lower side. But practice differs from theory. Volatility shouldn't be considered a risk. The definition of risk by Warren Buffett is the probability of losing the principal. One way or another, it all depends on how well equipped you are to analyze the market and how patient you are. These types of happenings can vary from investor to investor. Some are active investors, while some are passive investors. The next step is to determine which type of investor you would want to become, passive or active. Passive versus active investing strategies. When getting into the world of investing, some people like to play it aggressively and look for short and quick money, while some look for long-term benefits and want to run a marathon instead of a sprint. Well, active investors depend on short-term fluctuation in the market to gain their profits. They look to earn quick money, while on the other hand, passive investors don't really care if the market is going up or down at the moment. They look for long-term sustainability. For example, if the market is down today, it won't remain this way forever. Active investors generally have higher risk tolerance than passive investors. They are usually willing to risk more money for better returns. While on the other hand, passive investors have a low risk tolerance and they are likely to play safe. Active investors are usually a lot more involved than their counterparts. Active investors target specific stocks, bonds, or assets. While on the other hand, passive investors look to target index funds, ETFs, and it's always clear about which assets are in an index fund. So which of these strategies do you think will make more money? But how many stocks should a portfolio have? If you're looking for an ideal number of stocks in a portfolio, then you won't get one. Stock requirements for portfolios can vary from investor to investor, and there isn't an ideal number of stocks to buy. You can have 20 or a minimum of 60 stocks in your portfolio, but that completely depends on what sort of long-term goals you have in mind. However, the most commonly known strategy and advice is to go for diversification in your portfolio. Diversification. In theory, the strength of any portfolio is its diversification. With diversity, you can easily look for changing margins in the market, and it can prove you with more options to analyze your moves. Diversification of your portfolio means that you have more chances to earn a better return rate. But a small number of companies isn't going to provide you with the required diversification. For this particular reason, you'll need more stocks in different sectors of the market. Experts might say that somewhere between 20 or 30 stocks is the sweet spot for optimum results. But they can often get concentrated, and then a single decision of price change by a company can leave a big effect on your overall performance. It is important to have diversity in your portfolio. Your stocks will not move up and down at the same time. For example, if you have stocks in the green, blue, and red zone of the market, then if the price of the green zone goes down, that doesn't mean the blue zone would go down as well. In this way, diversity provides you with the necessary safe corner in the market. As we said, diversification in theory strengthens your portfolio and lowers your risks. But we don't believe that diversification can benefit every investor's portfolio. As Warren Buffett said, diversification is a protection against ignorance. It makes little sense for those who know what they are doing. But there's a whole topic for another video. Now you know the steps to build a stock portfolio, but before you start researching the stocks with the highest discrepancy between value and price, you need to know that there are 6 stock categories and you should analyze each of them differently. To know everything about the 6 stock categories and how to allocate them in a portfolio, grab our free ebook in the description. So, what is your risk tolerance? Do you consider yourself an active or passive investor? Let us know in the comments below. Check out this video we handpicked for you, and we'll see you in the next one.